Interestingly, we have new hints coming up from the Federal Reserve with regards to the balance sheet development. I've introduced the so-called Waller rule over the course of the week, and it relates to a speech given by Chris Waller, one of the members of the FOMC, just last week. He talked about whether the Federal Reserve will continue withdrawing liquidity from dollar markets via the so-called quantitative tightening program, now that the economic growth momentum is starting to wane. Welcome to this fourth edition of Steno Signals. I'm still overwhelmed by the feedback we've received on the first three editions of this show. Thank you very much for all of the comments. I will try to answer as many as possible on an ongoing basis, so please keep them coming after this show as well. We've had three major themes so far in this show during 2023. First of all, the disinflation in the US, CPI coming down in year-over-year terms. We've had a theme on the Chinese reopening, and we've had a theme on dollar liquidity. And I've promised you to provide an update on the themes on an ongoing basis. So let's have a look at the developments in inflation first. I think we've received new, interesting evidence of abating wage pressures over the past week. We see signs of abating wage pressures in posted job openings. So we can measure that via the Indeed Hiring Lab indicator. And it is usually a very good early indicator of the Atlanta Fed wage tracker, which is essentially one of the most important gauges of wage growth in the US and one of the gauges that the Federal Reserve will look at on an ongoing basis. And clearly now we see a fading trend in the wage growth relative to just a few quarters back. And I think this is one of the first signs we need to see before we can convincingly call a top in service inflation. So the inflation in healthcare, education, and other employee-intensive sectors. And that is of great relevance to the Fed outlook a few months down the road. For now, they will stick to their guns and continue hiking interest rates. But if we get fading price pressures in the service sector, this is probably the first sign of a pause from the Federal Reserve. So I continue to lean that way. The inflation outlook is waning in the US, despite an increase in gasoline prices, because the broad basket is now showing signs of deceleration, not least in wage growth, which is of great importance to the Fed reaction function down the road. And we'll get back to that exact reaction function because it will get very interesting in a few months from now, not least when it comes to the decision making on the balance sheet size of the Federal Reserve. We know how important it is to equities and to other asset classes. So if the Fed will allow the balance sheet to run off continuously over summer, it is something that we need to watch. And I think they've given us a hint that the quantitative tightening program will be allowed to run for longer. But more about that in just a second, because I want to show you a few charts on the Chinese reopening as well. We discussed a few weeks back whether it was a grand reopening or not. And I think it's safe to say by now that China is open for business. I've borrowed a chart from one of my great friends, Warren Pies, who's on top of the traffic and transportation developments in China. And it is crystal clear by now that the flight activity is back to what I will call normalized levels in China. We are running at the swiftest pace of daily flights in China in over a year. And to me, that is a great signal that China is actually open. Whether the economy is back at full speed is another question. I think it's kind of doubtful still, but we have early hints of spillovers to economies with a clear tie or link rather to the industrial parts of China. We received the latest set of purchasing manager indices out of Europe this week, and we saw a bounce in the German PMI relative to the French PMI. And I think that is interesting given that Germany is clearly a country with closer ties to the Chinese economy relative to the French economy. And therefore, this bounce in German activity relative to French activity may be a clear signal that China is at least gaining speed relative to what we saw just a few months back. And we still have clear spillovers to relative pricing in asset markets and equity markets from this Chinese reopening. We've had a massive start to the year in European equities as a consequence of this reopening. We have clear spillovers to the commodity space. Industrial metals are performing as I basically highlighted a few weeks back. And energy is also moving. Not to the same extent in equity space, but energy commodities are on the move as a consequence of this Chinese reopening as well. So I think it's safe to say that China is open. Whether it's a huge economic comeback is still questionable. And I think it ultimately boils down to the question whether the clients of China in the West will regain momentum during the spring, and I still have my doubts around that question. We will get back to why in just a short while. The third topic of relevance so far in 2023 is the topic of dollar liquidity. I went through how the debt ceiling will ultimately end up adding liquidity to dollar markets counterintuitively as a consequence of the US Treasury being forced to draw down on its reserves at the Federal Reserve due to this debt ceiling now being in force. So the Treasury general account is now at roughly $330 billion. So we've had another addition of dollar liquidity from that account to commercial banks over the course of the past 10 days. As a consequence of the US Treasury basically spending cash they have idle at the Federal Reserve as a consequence of the debt ceiling, they will have to bring the level of this Treasury general account below $100 billion ahead of the ultimate deadline, the so-called crossover date, the date where the US Treasury is no longer able to pay bills. And that date is probably only 3 to 4 months away. The best assessment we have of the crossover date right now is from the US Treasury itself. And they aim at a crossover date in June if they exhaust all extraordinary measures.
Hi, I'm Raoul Pal, the CEO and co-founder of Real Vision. The financial world is a complicated world right now. It's a really complicated macro picture, and there's a lot of risks. Real Vision and our YouTube channel help you navigate those risks. So subscribe now to the channel and never miss an update. There is simply too much going on. So subscribe now. Thank you.
And I want to highlight the words extraordinary measures again. I briefly touched upon the extraordinary measures they now take in last week's edition of Steno Signals. But it is important to note that the US Treasury can still issue debt, even with the debt ceiling being in force. It is a consequence of extraordinary measures that they take now. For example, they can issue debt to the same extent as they have holdings in the so-called Government Securities Investment Fund, so the G Fund. And that is a pension fund for public employees of the US administration. And the pension fund holds US Treasuries. And the US Treasury is now allowed, as a consequence of these extraordinary measures, to issue debt to the same extent as this fund holds US Treasuries to counter that. And we know that the fund currently holds roughly $270 billion worth of US Treasuries. So the US Treasury will be allowed to issue, for example, Treasury bills when they counter that with the holdings of the Government Security Fund. And that is of relevance for the issuance outlook over the coming months. The US Treasury will continue to issue new debt despite this debt ceiling. So let me just emphasize that they can still issue debt for another couple of months outside of emptying their cash balance at the Federal Reserve, which is a liquidity addition to private banks, as private banks will be on the receiving end of the dollar liquidity when the US Treasury decides to bring down this cash balance at the Federal Reserve. And interestingly, we have new hints coming up from the Federal Reserve with regards to the balance sheet development. I've introduced the so-called Waller rule over the course of the week. and it relates to a speech given by Chris Waller, one of the members of the FOMC, just last week. He talked about whether the Federal Reserve will continue withdrawing liquidity from dollar markets via the so-called quantitative tightening program, now that the economic growth momentum is starting to wane. And his rule of thumb is that the amount of dollar liquidity in the system needs to be roughly equal to 10% of the gross domestic product for it to be in balance. And currently, there are more dollar reserves in the financial system relative to the rule of thumb of 10% of the gross domestic product, which basically means that the Federal Reserve will continue to withdraw dollar liquidity month after month in this quantitative tightening program. This is a counter effect to what I just described from the US Treasury. The US Treasury will add liquidity while the Fed will withdraw liquidity at the same time. Net, we should still expect a liquidity injection over the course of February and March. But when we get closer to summer, the net equation will turn negative for dollar liquidity again, as long as the Federal Reserve will continue its quantitative tightening program. To reach this rule of thumb of 10% of the gross domestic product, we need to bring reserves or dollar liquidity down to levels around 2.55 to 2.6 trillion US dollars. And we are currently stuck at above $3 trillion. So they will have to withdraw in between 5 and 600 billion worth of dollar liquidity from now and until the end of the QT program. And on my calculations, we will reach this equilibrium of 10% of GDP in between week 30 and week 40, so towards the early autumn. And at that point in time, it is clear that the Federal Reserve will have to discuss whether to continue with dollar liquidity withdrawals. But it still means that we have dollar liquidity withdrawals ahead after this short-term injection of liquidity from the US Treasury. And last week, I highlighted how a liquidity injection is positive for equity markets, negative for the US dollar. An ongoing dollar liquidity withdrawal into the autumn will have the opposite effect. So ultimately, it will prove to be dollar positive likely and also negative for risk assets. I've tried to paint the path forward for dollar liquidity relative to the S&P 500 on this chart. And it is based on my forecasts for dollar liquidity, taking US Treasury liquidity into account, taking the quantitative tightening program into account, and taking effects from the so-called overnight reverse repo facility into account. Those are the three main drivers of dollar liquidity. And as you can see from the chart, we have a short-term spike, which is positive for equity markets. But as we get on the other side of this debt ceiling, we will see substantial liquidity withdrawals in a matter of months. And towards October and into the ultimate part of the year, we will get to new lows in dollar liquidity for the past couple of years, which also means on most recent correlations that we will ultimately see new lows in equity markets as a consequence of this dollar liquidity withdrawal. This is a very tight correlation between dollar liquidity and the S&P 500 since 2020, so basically since the pandemic. The correlation is not as tight if you look further back, so bear that in mind. But the short-term correlation has been extremely tight. And if I'm right that liquidity will have to dwindle until the autumn, it may be worthwhile looking into more defensive strategies on the other side of this short-term liquidity injection from the US Treasury, which will probably allow equities to have a few decent months ahead still. And if we look at the link between dollar liquidity and ultimately the recession, then I would argue that a withdrawal of dollar liquidity is bad news for the economy overall, since it leads to less risk-taking, fewer projects, fewer investments as a consequence of the price of liquidity increasing. And therefore, there is a link between dollar liquidity and interest rates, first of all. If liquidity is withdrawn, it's typically a positive for interest rates and credit spreads. And therefore, ultimately, I think even though we're currently stuck in a discussion on whether this will end up in a soft landing, I think we should ultimately expect the recession to arrive in the second half of the year as a consequence of this liquidity withdrawal. And there is a tight link between interest rates and the economic activity in between 12 and 18 months after that increase in interest rates. And we are yet to see the worst part of that impulse on the economy from rising interest rates. The chart I show here is the relationship between 10 and 2-year bond yields in the US and the subsequent activity in the ISM manufacturing index. And as you can see from the light blue line, we will be faced with headwinds into the autumn as a consequence of already delivered rate hikes and credit spread widenings through 2022. So it's not a time to call off the recession. It's just a time to postpone it as a consequence of this liquidity injection short term. But ultimately, we will, sadly so, be hit by this recession, I think, towards the second half of the year in Q3 and Q4. And if we look at the link between the economic momentum, financial markets, and the purchasing manager indices that we use to gauge the economic momentum, then I would argue we receive new information week after week that the US growth momentum is still fading. We received an update on the so-called leading economic indicator from the Conference Board this week with a print of minus 1% month over month, which historically correlates with a level of in between 40 and 42.5 on the ISM manufacturing index just 1 to 2 months from now. So we still see downside in economic activity despite this liquidity injection short term that has helped markets rally through the beginning of the year. And if we go in details, the manufacturing sector will likely suffer still, but the worst of the momentum may be behind for the manufacturing sector. The manufacturing sector is already printing below 50 in most gauges of PMIs, which means that the sector is already contracting. So it is not even slowing anymore, it is outright contracting on a monthly basis. And if we use the leading economic index from the Conference Board and the yield curve 12 to 18 months ago, we get to a level of around 45 for the ISM manufacturing in the months ahead. So clearly in contractionary territory. The big issue for the economy is that we now also get to the conclusion that the service sector, 80% of the economy roughly, will also be hit by a contraction in, say, 3 months from now, roughly. I again use the leading economic index and the lagged consequence of interest rate hikes from 2022 as an indicator for the ISM service index, so the index with the sort of broadest exposure to the US economy. And here we get a conclusion relatively close to what we get in the manufacturing sector. We will see levels below 50 in the ISM service sector over the course of the spring, and that is ultimately what is called a contraction or a recession. So I think this recession is still likely to occur. The timing of the recession was postponed by this Chinese reopening by the liquidity injection from the US Treasury, but ultimately the recession is sadly still likely to hit the US economy, probably by early Q3 at the latest. And therefore I want to conclude with a broad roadmap for US equities in light of this discussion on liquidity injections and subsequent withdrawals. Short term, we've seen how this liquidity injection has spurred life back into Tesla and other high beta stocks in the consumer discretionary category, in the tech stock category, and other equity classes with a very bad performance in 2022, while some of the more defensive sectors, utilities, healthcare, consumer staples, they've had a flat beginning to the year. I think that's a consequence of portfolio managers being positioned in these asset classes at the sort of as a consequence of the outlook of a recession, and now they are moving their exposure to more risky assets such as tech and consumer discretionary. But if I'm right that the liquidity situation will turn around again in 3 months from now, then I think some of these more defensive sectors, such as utilities, healthcare, and stables, will be back in fashion. But for now, as I've said over the course of the past 3 weeks, I would ride the momentum in equities, I would ride the momentum in commodities, and I would ride the momentum in terms of a weakening US dollar. Those three things go hand in hand with the liquidity injection, and I'm still very firm that we will get that liquidity injection from the US Treasury in February and March. But according to the Chris Waller rule from the FOMC, we should expect liquidity to dwindle into the autumn. So sadly, we will not get through 2023 without clear volatility in equities again, if this Waller rule is right. So that was all for the 4th edition of Steno Signals. Once again, I would like to remind you that this is not financial advice. This is a window into my thinking on dollar liquidity and other global macro themes. I cannot guarantee you that my time horizon is the same as yours, that my risk appetite is the same as yours. So do your own due diligence and do your own research on dollar liquidity on the back of this video. We will be back again next week with another update on the most important global macro themes and how I ponder trading them. Thank you for watching this edition of Steno Signals.
We hope you enjoyed the video. At Real Vision, we help you understand the complex world of finance, business, and the global economy with in-depth analysis from real experts. Join the revolution at realvision.com.